absolutely. Go ahead.
So I follow equities more often than I follow bonds and credit. But what effect has like this crisis had on the bond market, and like what does that mean for like the fundamentals for these companies from our standpoint?
No, it's increased default risk. Default spreads have gone up with the equity risk premium. So it basically means when you do your cost of capital, not only is your cost of equity gone up, but so is your cost of debt, and the failure probability is higher. So it shows up in your valuation in multiple places, right?
Hmm. And well, with the lowering of the risk-free rate, I mean, I guess that.
There are some good things and bad things that come into your valuation. So you have a lower risk-free rate, which helps you, but you have a higher default spreads and higher equity risk premiums and a higher failure probability. And also you have those bad effects on your earnings and cash flows. How it all plays out will tell you how much your company will be hurt by the crisis, or perhaps some companies it might actually help them.
Okay, thank you.
Welcome.
This meeting is being recorded.
But Professor, quick question.
Yep.
When is the project due? I forgot the due
May
date.
11th.
May 11th. Okay.
Yeah. So that's that was would have been our last day of class. So that's May 11th. And I will put out a Google shared spreadsheet later today. And what I'd like you to do as you get the numbers, but many of you already have your DCF values, is go into that Google shared spreadsheet and enter at least the numbers for your company when you get ready to do it, because I'd like those numbers for my very last session, which would be May 11th. So that those numbers are not, no, it's just 5 numbers in your company or 7 numbers. It's not going to be a big deal, but when you get the numbers, you don't have to wait till your report's actually done. If you can put those numbers in, it'll help me a great deal for my last class.
And also the project includes the pricing and just the pricing and DCF, right?
And if your company is, and I'm going to start today's session by talking about using that option pricing model on your company. And for some of you, maybe 1 out of every 6 or 7 of you, there might be a way to apply an option pricing model to get a third value for your company. And then also recommendation. Don't forget that you got to wrap it all up and say, I'm going to buy or sell. So I'm not going to let you kind of wiggle away with just numbers and saying, I don't know what I'm going to do now. I'm going to put you on the spot.
Is that similar to the blog post that you make? Like similar structure to that?
Yeah, it's you can find your own structure, but basically it's not purple prose. You're going to give me your DCF summary, which probably you can, if you do the story page on my Excel spreadsheet, you can just make a picture of that story page and put it in because it has all the details that describe your DCF. You're going to show me your pricing, what multiple you use, what comparables, and what your conclusion that was, and you'll summarize with the recommendation, buy, sell, or hold. But the whole thing shouldn't take more than 2 or 3 pages for a company. So if you're doing 5 companies, you're looking at 10 pages maybe for the whole report. But each company, that's what you're doing, DCF, pricing, recommendation. If there's option pricing, you add that on as well. Okay, so I am glad to see many of you know. I mean, obviously, people have. Today was a quiz day, so I noticed most of you have taken the quiz, which is good. So today's session is going to be a short one, and I'm going to finish up option pricing. Now, as I go through this last step in the process, I'm also going to talk a little bit about applying option pricing to your company. And I'll tell you up front, for most of your companies, you really can't apply anything we talked about with option pricing to your company, even if it's a pharmaceutical company. Why? Because the specifics you need to value a patent as an option, you will not have access to unless you actually work at the company. So if you worked at Pfizer, you might be able to value a drug as an option, but you can't really do it if you're an investor. So the one place where you might do option pricing is if your equity is distressed. What does that mean? Well, we remember the example we talked about, a company where the debt is a 0 coupon bond. We talked about how the value of equity can be viewed as an option, a liquidation option. So in today's session, what I'd like to do is put some flesh on that concept. So before I do that, there are any questions on the real options component or an option pricing you want me to address before we jump into how would I value equity in a company as an option? No? Okay, so let me go back to that hypothetical example. I made life easy for myself in that example because here are some of the things that characterize that example I used last session. There are only 2 players in this game, debt and equity. You're saying, so what? Well, some companies have hybrids. So I assume those are aware. Second, there's only one issue of debt outstanding. It was a nice zero coupon bond and it had a face value. And I also gave you the value of the firm and the variance in that value. So in the example, I said the value of the firm is 100 million, the variance is 0.16. I can say there's one zero coupon bond with a face value of 80 million due in 10 years. And then I gave you a risk-free rate. But let's assume you want to try this on a real company. Here are some of the challenges you're going to face. When you take a real company, you have to estimate value. Nobody's giving it to you. So the question is, how do you estimate that value? If you've done a DCF value for your company already, remember that value of operating assets you came up with for the company? You can use that as the S in the model, as a value. So wherever I put the 100 million, you can use your DCF value of the operating assets. I'll give you a specific example so you can see how this will play out. Or you can, if you want to cheat, take the market value of equity and debt and just add them all up, which is really cheating. Why? Because then you're kind of reverse engineering from that number. So the best way to get a value for your underlying assets is to do a DCF value, take the value of the operating assets, use that as the S in the model. To get a variance in that value, I'll give you a shortcut and a long cut. If you really want to do this really well, you probably should do a Monte Carlo simulation evaluation. But that's really messy, right? You got to make assumptions about, what your, market, revenue growth will be, and you have to put distributions on all of them. I don't expect most of you to do that. So here's the shortcut. Let's say you have a steel company that you're trying to apply the option pricing model on. If I could give you the variance in steel company values, you could use that, right? A bottom-up variance, just like a bottom-up beta. I actually have that on my website. So I would argue that if you're doing an option pricing model, that you use that variance as your variance in value so that you're not trying to estimate it yourself. So you have a value of the firm coming from your DCF value, a variance of that value by looking at the sector you're in and the typical variance in that sector. But you now need to know how much debt you have. I'll tell you up front that you will never have a troubled company where all of the debt takes the form of zero coupon bonds. Your debt is going to be all over the place. You're going to have 10 different debt issues. Here's what I'd like you to do. Add up all the debt you owe and act like it's one zero coupon bond. Give it the weighted average maturity. So if you have 10-year debt, 3-year debt, 5-year debt, take the weighted average maturity, make that the maturity of your zero coupon bond. What you're doing is you're playing a little game. You're taking all this complex, messy debt and replacing it with an equivalent zero coupon bond. So when you're done, here's what you're going to have. Your DCF value will become the S in the model. The face value of all of the debt you have will become the K in the model. The average maturity of the debt will become the life of your option. And the variance in firm value will just come from looking at the business you're in. So now, let's ask about what kinds of companies you should even be trying this on. If you are the person valuing the money, remember one of you had to value money-losing company? If you're valuing money-losing company, here's the other requirement, which has a lot of debt. You can value the equity as an option. So if you're valuing an airline, you're valuing Boeing, there's optionality here. What's your option? Well, you might be getting a negative equity value. About, I know quite a few of you are valuing companies where you got a value for your equity which was negative. Yesterday I got a valuation of Delta Airlines where the person valuing the Delta said, hey, I came up with the value of the operating assets. It's less than the outstanding debt. The equity is worth nothing on a DCF basis. That's perfectly okay. In fact, I wouldn't be surprised if you're valuing Korean Air or you're valuing Lufthansa if the value of your equity is negative. But think of the equity as an option. The DCF value, even though you got a value of equity that was negative, your value for the operating assets was actually positive. Make that the S in the model. You have a huge amount of debt. That's what's making your equity negative. Make that the K in the model. Try to get a weighted average maturity. And I'm going to show you how I would get it for a typical company. And put that in as the life of the option. And value the equity as an option. And you're going to find that even in companies like Korean Air, where the equity has dropped to a fraction of the overall value of the company, it'll hang in there because of the optionality. So those are the inputs, and I'll use a very simplistic example to bring this home. About 20 years ago, I valued Eurotunnel. And Eurotunnel, for those of you who don't know, is a tunnel that connects UK to France. It was built with huge plans of, you could make money on this tunnel. People would drive through and they pay these large fees. It turned out to be a hole in the ground where cash went in and never came out. So this was in 1997 that I valued Eurotunnel. And here's what Eurotunnel looked like. It had earnings before interest and taxes of minus 56 million. So it was losing money on an operating basis, net income of minus 685 million. So one of the conditions is met. It's a big money losing company. To add to the pain, its book value of equity had turned negative. What does that mean? It's been losing money for a long time. So Eurotunnel is a money losing company that's been losing money for a long time. First requirement is met. Here's the second requirement. They had a huge amount of debt. 8.865 billion pounds of debt outstanding. And a lot of it was very long-term debt. So in fact, if you look at the debt, some of it is short-term, some was 10 years, some was 20 years, some was longer. What I did was I took a weighted average duration of the debt. If you don't know how to compute duration, just use the maturity. So basically, they have 8.865 billion pounds of debt with about 11-year duration. So it's a big money-losing company with a lot of debt. I've met the requirements. I can value the equity in Eurotunnel as an option. So here's what I did to complete the process. I did a traditional discounted cash flow valuation, doing what all of you had to do, right? Improve margins, put in revenue growth. And even with fairly optimistic assumptions that revenues would grow 5% a year, remember this is a tunnel in the ground, you're not going to get 50% growth, and that they'd be able to improve their margins to about 15%. Now, I value the operating assets of the tunnel at 2.3 billion pounds. Let me pause right there. I am assuming that the tunnel survives, becomes profitable, and I'm getting a value of 2.3 billion pounds for the tunnel. How much money did Eurotunnel owe though? Go back to the previous page, 8.9 billion pounds. I'm estimating a value of 2.3 billion pounds. The debt outstanding is 8.8 billion pounds. If I was showing this as a DCF, you know what my conclusion would be, right? The value of the equity is negative, don't buy the shares. But think about it. When you buy equity in this company, you're buying an option. Option why? Because the debt really is not due for a long time. It's not due for 11 years. What are you hoping for? You're hoping for a miracle. You're hoping that your revenues will jump and that your margins will improve, that something will happen that will make the 2.3 billion into 11 or 12 or 15 billion. You're saying, there's a very small chance of that happening. You're right, there's a very small chance, but there is a chance. That's what the option pricing model is going to try to do, is to value the equity in this company as an option. But what's making it an option is not just the fact that the debt has a long life, but that the things can happen that can change value. So to estimate the likelihood that the value that I got of 2.3 billion would change, I estimated a standard deviation in Eurotunnel's value. And here, because I could not find a sector to really put it into, because in 1997, how many tunnels were publicly traded around the world? I actually backed into a standard deviation in value for Eurotunnel by doing this. Both Eurotunnel shares and bonds were traded. The standard deviation of the stock price was 41%. The standard deviation of the bond price was 17%. So they were both traded. I could actually measure their standard deviations. I don't know whether you remember, but when you did portfolio management, one of the first things you do is the variance of a two-asset portfolio. We actually talked about this when we talked about it last week. Two-asset portfolio. Think of the stocks and the bonds as a portfolio in this company. And 15% of the value for Eurotunnel came from equity, 85% from debt. I'm computing the variance of both the equity and the debt put together in the company. And I had to bring in the correlation. Stock and bond prices of Eurotunnel moved together about 0.5 of the time. That's a correlation. The variance that I got in firm value for Eurotunnel is 0.0335. This is the step I'm saving you on for your company because I said use the industry averages. So here's what I have. I have the value of Eurotunnel's operating assets from my DCF, 2.3 billion. I have the face value of the debt, 8.9 billion. That's all the debt outstanding. I have the weighted maturity of the debt, 10.9. I use weighted duration, but if you use weighted maturity, that's perfectly okay. I have the variance from the last page, 0.0335. And I computed a riskless rate based on the life of this option, about a 10-year option. I did N of D1 and D2, N of D1 and N of D2. Let me pause right there. Remember what we said N of D2 tells us? What's the 7.5% measuring? Anybody? Dave?
It's the probability that the option's in the money.
Okay, so let's write, you're absolutely right. So there's a 7.5% chance that, so what's the S here? It's a value of the assets. The K is the face value of the debt. There's a 7.5% chance that this company will have a value greater than its debt, which means there's a 92.5% chance of what? What happens when the value of your assets is less than your debt?
Go bankrupt.
You're going bankrupt. There's a 92.5% chance that Eurotunnel will go bankrupt. But remember, in options, you look at the glass even an eighth full or 1/10 full. You look at the 7.5%. That's a small probability that the value can be greater than the debt. You know what? The value of the call reflects that. This is a beyond basket case company, a company that you look at and say, I would never buy equity in the company. And you'd be absolutely right if you bought equity for the conventional reasons, for cash flows, for dividends. But if you think about the equity as an option, that 122 million captures the value of the option. So now you can see why most of you will not be using this in your company. There's no point doing this for a Microsoft or an Apple. But if you're talking about valuing a United Airlines or a Delta Airlines today, or any of these or a shale oil company with or Occidental, maybe when you do your DCF, you're going to conclude the equity is worth either nothing or zero, or I'm sorry, nothing or even a negative amount. But when you think of it as an option, it might still have value. Why? Because oil prices are volatile. Because airline businesses can change over time. And what you're effectively paying for when you buy shares in these companies is you're buying an option. Okay? So I want to make sure everybody gets the mechanics of the 122 million. What I'm capturing here effectively is, even though the value of the assets is well below the face value of the debt, because the debt is so long term, the equity still continues to have value, because you're hoping that something good will happen. Then you're praying that something good will happen. Most of the time, nothing good will happen. But the fraction of the time when something good happens, you're hoping your equity will explode in value. Dave, you have a question?
This might be a little bit of a dumb question, but I just want to reconfirm and clarify. So you should only be doing this if your equity value is lower than your debt value, right?
No, not the debt value. You're talking about equity value being less than the value of the operator. So I'm not sure what you mean by equity value being less than the debt value. You should be doing this if you have a company that is in trouble, that has a lot of debt, right? So the equity value being less than the debt, maybe is that what you mean by having a lot of debt?
Is the equity value lower than the face value of the debt?
That's where the optionality would be greatest, but it's not restricted to that. Or you could actually argue that for a Boeing, even though the equity value, not the equity value, I think you're talking about the value of the operating assets being greater than the debt.
I'm sorry. I'm sorry.
It's true that if the value of the operating assets is less than the face value of the debt, you definitely have to do it. You have no choice. So if you're valuing an airline, you're getting a negative equity value, you definitely have to do it. But let's say you're valuing Boeing. The value of the operating assets is greater than the face value of the debt. But there's some optionality, right? Optionality is not a 0-1. Just because you're in the money doesn't mean that the optionality disappears. So I would argue that if you have a company with a lot of debt, even if the value of the operating assets is greater than the debt, you might be willing to pay an extra premium in this company if there's optionality. And that optionality comes from the fact that, so let's say your value of the operating assets is 11 billion, the value of the debt is 9 billion. 11 minus 9 is 2, right? So in a DCF, you're going to say my equity is worth 2 billion. What the optionality will do is it'll take the 2 billion and add a premium to it, saying there's more upside than downside. Why? Because what's the lowest value your equity can take? It can't drop below 0. But the upside is could go to 10 billion. That's what the optionality is capturing. So don't stop just because you got a positive value for equity. If your debt is a big number, and I would say if it's greater than 70 or 80% of your overall value, then I would do this, because there would be optionality still in your company.
So just a clarification, when you say the value of the underlying assets, you mean the book value of the equity and debt, book value, right?
No, just take the market value today, right? You have a market value of equity and you have the debt outstanding. Add the two numbers up. Just compute a debt ratio for your cost of capital. It's a market value debt ratio. If that number is 60, 70, 75%, then try the option pricing model.
Okay.
In fact, I think that answers Paul's question. Paul, did I answer your question? Because he said, what's a good threshold? Look for a 60% debt to cap ratio in your cost of capital. And if it's 60% or higher, then try you can't lose. There's really, it's not displacing your DCF. What's the worst that can happen? You try the option pricing model. There's not much option value. You can let it go. So if your debt ratio is a high number, and many companies at high numbers come about because their business has collapsed, then try the option pricing model. And if you have a negative equity value, you definitely should try the option pricing model. Yesterday I got a valuation of somebody who valued, I think it was Nordstrom's, and got a negative equity value. And I suggested using the option pricing model to them simply because Nordstrom has had a lot of debt and they got a negative equity value because the value of the operating assets was less than the value of the debt. And I completely accept the negative equity value for the DCF, but there still might be some optionality here.
Just one more quick question.
Yeah.
NFD1 0.203, that represents the number of shares that you're buying.
In a replicating portfolio. But then remember, replicating portfolio will be a complete nightmare, right? How would you exactly replicate Eurotunnel? So, but technically that's what NFD1 measures.
Okay.
Think of it as also as a probability. If you ask me what's the probability of default here, I'd say 7.5 to 20%. Do you see where I get the 20%? 7.5% is the actual probability. 20% gives me the outer end of the range.
Okay.
Yeah. Any other questions on this example? So if you think about real options, here's what I want you to keep in mind. There are real options everywhere. There are options to expand, options to abandon, options to delay. Most of these options don't have significant economic value. Why? Because there's no exclusivity. So when you think about, should I apply an option pricing model? If there's no exclusivity, don't even waste your time. When options have significant economic value, then the question becomes, can I use an option pricing model? And if you think about the tests, is there an option? Can I trade the underlying asset and the option? Many of these real options aren't really pushing the limits of option pricing models to the point of perhaps breaking them. So you're saying, why do we do it then? Because understanding when something is an option changes your perspectives on how you think about that investment, right? So if you think airlines, the only reason for the value of the equity is the optionality. Do you want airlines to become a riskier business or a safer business going forward? If the value of the equity in airlines is coming primarily from the optionality, do you want more? You want it riskier, as Paul said, because that's the only way you're going to get above water. So you don't want the business to get stable at a bad point. You want it to be unstable until you get to a good point. It changes your perspective of risk. And that is important because you're then kind of so if I asked you to create a vulture investor's portfolio, the way you'd create a vulture investor portfolio where you buy distressed equities would be very different than from somebody who's building up an equity portfolio where they want nice healthy companies that deliver much in cash flows. And I think understanding why flexibility matters, bringing an optionality is a good way to think about why companies need to preserve flexibility. Before the start of this class, we were talking about Tesla, and at the start of the last class, I was talking to somebody about Tesla. They're valuing Tesla, and one of the questions they brought up, and I'm going to throw this out to you, is why is Tesla's price going up? In fact, it's very quickly approaching prices it had before the crisis. It might very well go through that. And I said it's entirely possible that this crisis could strengthen Tesla as a company. Do you see why? Because in a sense, all their competition is saddled with all this infrastructure and large costs. Tesla is a very flexible company. It's flexible partly because Elon Musk has never built the assembly lines when he should have. And that's working out in his favor now. So I think the flexibility that Tesla has to scale up and scale down production is actually going to stand them in really good stead in this crisis, which means after this crisis, in a strange way, Tesla will be a stronger company than it was before the crisis. So if you get a chance, go back and remember that do-it-yourself valuation we did of Tesla? Take that valuation and ask yourself, how would this valuation change now that we've gone through this crisis? Okay. So again, summarizing this options part, for most of you, you're not going to be doing an option valuation of your company, even if you're a money-losing company, because money-losing is only one half of the equation. You also need debt in the picture. So if you have a money-losing company with a lot of debt, then give it a shot. Now the spreadsheet, actually, and I'm going to pull up the spreadsheet so you can see what the spreadsheet looks like. The spreadsheet that you're going to be using is actually a spreadsheet that I'll send you the link. Okay? So I'll lead you through what you're going to have, right? So the spreadsheet looks like this. It has the Black-Scholes model built in. Where you have the stock price, you're going to be introducing the DCF value of your operating assets. Let's take an example. Let's say you're valuing United Airlines. You got a DCF value for the operating assets of, let's make up a number, 15,000 million or 15 billion. But let's say that United has 20 billion in debt. If I stopped right there, the company is obviously in trouble. The value of the operating assets is less than the value of the debt, right? But let's say this debt has a maturity of 5 years. So they have 5 years to play the game. Risk-free rate right now is close to 5. So let's say it's 0.75%. And let's have variance in airline companies. And remember I talked about industry averages? This is built into the spreadsheet. You can see for airlines, for instance, that the standard deviation firm values in the third column is about 22%. So I take 0.22 raised to the power 2. Sorry. Why raise the power 2? Because 22% is the standard deviation and I'm asking for the variance. And of course, United pays no dividends, so you can leave it at 0. So there's my value for the operating assets. There's the strike price is what debt I owe. That's the average maturity of the debt. Risk-free rate is just the T-bond rate, 10-year bond rate. And you can use a 5-year bond rate if you want to be precise. It's not that different. And the variance is going to be the industry average standard deviation squared. So let's look at the numbers. I just made up these numbers. My probability, if I asked you what's the probability that United will default with those numbers, it's about 22, says N of D2, 22%. I'm sorry?
I think we're still seeing the PowerPoint screen.
Oh, sorry.
No problem.
Okay, let me see if I can go back to Zoom and change the screen share. Can you see the Excel screen now?
Yeah, that's perfect.
Okay. Okay, so let me go back and start again because I'm sorry, I forgot that I was sharing the PowerPoint screen. So this is the spreadsheet that I'm going to send you. So let's assume, let me use a guinea pig. Did any of you get a negative value for your equity? Don't worry, I'll make you look really good. Ahmad, did you get negative? Okay, let's take Jeff. He said yes first. Jeff, who are you valuing? Oh, the yes was to, can you see the Excel? Never mind. Leandro, did you get a negative equity value? Nobody did? Okay, so I'll make up the company. Let's suppose I've been valuing United, and here's what I got. I got a value for the operating assets in my DCF of 15 billion. Oh, Leandro? Okay, Leandro, sorry, go ahead. Who are you valuing? I didn't see a mic up here, so.
Is it working?
Yeah, now it's working. Who are you valuing?
I'm valuing a discount retailer in the Southeast that goes by the name
Perfect.
of Tuesday Morning Corporation.
Oh, I know Tuesday Morning. I shop there all the time. So if you have your Excel spreadsheet, great. But if you can even remember some vague numbers, give it to me. Do you remember what you got as your value for the operating assets roughly?
I don't have the spreadsheet on me right now.
So let's assume you got 2 billion. I'm just making up a number. Let's say you know what I mean by value for the operating assets, right? It's what you get as the present value of the free cash flows discounted back at the cost of capital. That value of operating assets column. Let's say you got 2 billion. I assume they have a lot of debt, right? Lease debt, usually, mostly.
Yeah, pretty much.
So let's say they have 3 billion in debt, right? So there's your negative equity value. If I take the 2 billion and compare to the 3 billion, I'm saying this company is bankrupt. It's worthless. But let's say that debt, because it's leases, has an average maturity of 6 years. So I'm going to enter 6 as my maturity year. Okay? The T-bond rate has nothing to do with Tuesday Morning. It's just the T-bond rate. I should be using a 6-year T-bond rate, but let's say I used a 10-year T-bond rate. It's not that different, 0.75%. Your retailer. So here's what I'm going to do. I'm going to go look at. Remember I said that I've computed this bottom-up variances. If you look to the top of this spreadsheet of this worksheet, I have the standard deviation firm value. That is the number you should be looking for. And I'm looking at retail. So let's see what retail looks like. Would we put it in? You'd say general retail. Tuesday Morning carries all kinds of crap.
Yeah,
so I think it's general retail. So its standard deviation is 31.76%. So let's take that. I'm going to go to this column. I'm going to go enter 3176. That's a 31.76%, but I'm going to square it. Is everybody clear on why I'm squaring it? Because that's a standard deviation and the input's asking for variance, so standard deviation squared. So that's going to give me 0.1008. You can put the dividend yield at 0 because there's no way Tuesday morning is paying any dividends given the trouble they're in. So let's see what Tuesday morning looks like. N of D2 for Tuesday morning is about 19.7%. So what does that tell me, Leandro? What's the chance that Tuesday morning is going to go bankrupt with my numbers? There's a 19.7% chance that the option will be in the money, so there's a
Would it be
80, about 80.3%. No, 1 minus, there's an 80% chance of bankruptcy. But here's the fascinating thing. Look at the value of the equity. It's 376 million. You're saying, why would I pay for the stock? Because you're hoping that something good will happen. And you're praying that something good will happen. And most of the time, nothing good happens, but there's the option value. You're saying, what will happen if I have only 2 years left on my debt? Let's do some what if. Let's say the debt is short term. See what happened to the value of the equity? It dropped to 114. In fact, if I have only 10 days left on my equity, value of the equity goes to 0. As you get towards maturity, the value, so the longer the life of your debt, the more valuable the equity will become. Okay? What if my variance were much higher? Let's say I'm in a much riskier business, 0.5 squared. Look at what happens to my value of equity. Riskier businesses, the equity is worth more. So longer term maturities. Earlier, Dave asked, what if my operating assets greater than the value of my debt? So let's say it's barely greater, 3,200, right? So if I were doing a DCF, 3,200 minus 3,000 would be the value of my equity, 200 million. But because of the optionality, look at how much I'm willing to pay. So just because you get a positive equity value, don't stop, because if much of your value comes from the debt, you still have optionality, and that's what we're capturing with this particular option pricing view. So Leandro, here's what you'll end up having. You'll have a DCF value for your equity, which might be 0 because the value of the firm was less than the value of the outstanding debt. You might get a pricing, and I don't know what you got with the pricing, because you can get a positive number with the pricing because you're comparing against other retailers. And then you'll get the equity, the option value. I'm not going to force you towards one or the other, but you're going to get 3 different numbers for your company. And ultimately, what do you have to do? You have to decide whether to buy or sell. And you have to decide, make that judgment. There's no right answer here. Say, given these 3 numbers, would I sell short, would I buy, or would I just hold? So try this for your company if it's a company, as I said, that's money losing and has a lot of debt, but don't push it on companies where it doesn't fit.
All right, perfect. Thank you, Professor.
Okay. So in fact, you're all set to go. Go back to your DCF, plug in your operating assets and debt, and the only number you might need to look up separately is the life of the debt. But if you look at the footnotes to Tuesday morning, you can at least get a sense of it, and you're done. So it's an extra 10 minutes on top of what you've already done. Salma asked, what did we use for standard deviation? I just went to general retail. It's built into the spreadsheet. So general retail is right here, and you look at the 4th column, which is just the standard deviation in firm value. I give you 2 standard deviations, equity value and firm value. Use the standard deviation in firm value. Dave asked, what's a yellow box mean? This is actually part of a bigger spreadsheet. So I just played with the numbers and the output. Go in, and if you go to the top, there's an input there, so you can go back to, so that's there's a lot of rows above where I give you different ways of coming up with the standard deviation. So that's the yellow cells are all your input cells. So, So Dave, what's the number you want to? So the green numbers will be calculated if you use the full spreadsheet. But if you don't want to go through the full spreadsheet, you can just go directly to the green numbers and enter them yourself. But what's a number that you're a little confused about? So basically, I just take those numbers and I value the option. There's the value of the option right there. That's the value of equity as a call option. Right?
Wait, so how is that connected to the DCF value? Like
the DCF value was 2,000. So the DCF value of your operating asset was 2,000. The value of your debt was 3,000. So if I just did the DCF, 2,000 minus 3,000 is minus 1,000. So in a DCF, your equity value would have been negative. Hey, but with the inputs I put in, You're willing to pay up to 726 million for this equity because there's optionality here. So that's the value of your equity as an option. Your DCF value for your equity would have been negative.
Okay, and then secondly, for the annualized dividend yield, what if your current company doesn't have a dividend, but
Just put zero. If you have the kinds of companies you're going to be applying this, the dividend yield should be zero, right? Because it's you have a money losing company with a lot of debt. So if you have dividends, it's going to be very strange in this company to begin with. But if you do have dividends, just divide the dividend by the stock price, and that can go into the dividend yield column.
Okay, thank you.
Yeah. Any other questions? So this is only if you have, I'm keep re-emphasizing because I don't want you to be forcing your company through the spreadsheet if it doesn't fit. It's only if you have a company where you have, where you think the company's in trouble and there's a lot of debt. Unfortunately, there are a lot more companies that fit the option pricing requirements now than in February. So many of you might have started with nice, healthy companies at the start of the semester, and now they're companies that are distressed and you have to value equity as an option. So to know the questions, I am going to end with that today because I don't want to start with acquisitions. But before Wednesday's class, I'm going to send you this short, it's not even a quiz. It's basically a series of questions about acquisitions. It'll take you about 10 minutes to do. But please try to do it before class because during the course of the class, you're going to see these questions come at you. If you've thought through the answer to the questions, it'll make our analysis a lot richer and a lot deeper. So that's about it for today, and I will see you on Wednesday. Any final questions before we sign off? Okay, take care. Bye-bye.
Thank you.
Bye-bye.